Today we'll explore how investment companies help individuals like you and me invest in financial markets. They create investment portfolios that offer professional money management and diversification. The most common type is a mutual fund, which we'll dive into shortly. For example, Vanguard is a popular investment company managing over $8 trillion. They offer mutual funds, ETFs, and other financial products to investors worldwide. Investment companies are more than just mutual funds, though, although collectively they are referred to that. The idea here is that these companies invest in portfolios of which we can purchase into those portfolios. As you see here, in trillions of dollars, totally mutual funds, roughly about $23.9 trillion are in mutual funds. The other investments are along a broader description, if you will. The most popular really being ETFs. Closed-end funds and unit investment trusts are very, very small components of this entire market. A mutual fund pools money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. This open-end investment company issues new shares as investors buy into the fund. What makes it open-end? The structure of the corporation is such as that when we purchase shares, we're always buying in a primary market. The shares are always initial shares. So Vanguard 500 Index Fund, which mirrors the S&P 500 index, if you put $100 of your money in it, it is split amongst those largest 500 companies in the United States. So you don't need to buy each and every one of the 500 in their proportions. This mutual fund does that for you. So what is NAV? Net asset value represents the per share value of a mutual fund's portfolio. It's calculated at the end of the trading day. Relatively speaking, purchasing a share of a portfolio is far less expensive than buying individual shares. A company then can create unlimited number of shares in this opened mutual fund system, if you will. So anytime you want to buy shares, they will create a share for you. As you see here, you take the total value of all the securities in the portfolio, subtract any liabilities that the mutual fund company may have. They could have expenses or commissions or things like that that they owe to other people as they manage our accounts. And you divide that by the number of shares that day. So if a mutual fund owned 245 million in stocks, 187 million in bonds, 2 million in cash, and had $0.8 million in liabilities, and they had 18.5153 million shares, what's the NAV? In this case, $23.54. So again, the value of these assets are only calculated at the end of the day. And all shares of and purchases of mutual funds are done again at that end of day NAV. So these shares, they don't really trade like stocks. So if you buy at 2 p.m., the price you will pay will not be known until the closing bell. So what if you bought them on Saturday? What price would you pay? You won't know until the closing bell on Monday. Again, the structure of this, since the assets inside are changing prices, the end of day is when the mutual fund values are ultimately calculated at the end of the trading day for all the securities that could be in that mutual fund. Mutual funds come with various kinds of costs. We have what are referred to as loads. We also refer to these as commissions. You can pay a front load, that is, you pay at the time of purchase. You could pay a back end load. You pay at the time of sale. We also have what they sometimes refer to as a low load fund. These have very low loads, around 1 to 3%. And you could have no load funds. These funds don't charge a load at purchase or at sale. However, to purchase these, to find them, you have to do your own research. There are also some funds that run on an asset-based fee, where the fee you pay is a percentage of assets being managed. So we have these loads, commissions. We have management fees. Of course, there's the ongoing fees for the management of the fund, right? They need to get paid for the work that they're doing. And there are a variety of other fees. We'll talk about those as we go on. Here's just a graph, but kind of showing us the growth of funds, right? So uh, it shows obviously that the no load variety of funds seems to be growing much quicker than the load funds. Again, um, investors, they do the research to identify those investments. So you do a little bit more of your own work. They're not free, though, right? No load does not mean free, so there are costs involved in investing. Now, I have no evidence of this, but I think that a proportion of this growth that you're seeing here is the growth of index funds and the growth of ETFs within the mutual fund market. And I have no evidence of that specifically, but I think that has to contribute for a great deal of the growth there. So how do we calculate load fees, right? The load fee is a percentage of the offer price rather than the NAV. So in other words, what are you going to pay when you buy this mutual fund per share? You divide the NAV divided by 1 minus the load fee. So if the NAV is $23.44, the load is 2%, what would the offer price be? And again, 23.44 divided by 1 minus 0.02, $23.92. So if you wanted to buy a share of this mutual fund on this day, that is what you would pay, $23.92. Again, this is what's referred to as the offer price. Coming back to talk a little bit more about fees then, holding fees are charged while the funds are invested in the mutual fund themselves. So there is a management fee. It's charged to operate the fund. There's something called a 12B1 fee. These help to cover some of the marketing expenses in mutual funds. Now, the management fee plus the 12B1 fee plus any other holding fees ultimately work into what we refer to as the expense ratio. This is the actual percentage cost of owning the shares. Notice it doesn't have the load here. This is just what it costs to own the fees. Now, these holding fees reduce your overall return. The mutual fund is obviously required to report all of these costs as what they refer to here as the expense ratio. So again, these are the other costs, right? Mutual fund company is compensated for doing the job of investing your money. This is a percentage. And the 12B1 fees that we mentioned here were, in quotes, invented to kind of compensate no load funds for advertising. But now we find these 12B1 fees in all funds. So again, what are these fees? How much could they be? They could be as low as less than 1%, but they're rarely over 3%. So the fee is a percentage of the value of the portfolio, your ownership. So again, once we know what your value is, then you are assessed this fee based on the market value of that portfolio. Look forward to talking to you in the next video.